Welcome back to FT Markets. We're now in the fourth week of Eurozone quantitative easing since Mario Draghi, the European Central Bank President, started the programme of bond purchases. Shares have leapt, so too have bond prices, sending yields to historic lows. Quite a lot of government bonds now trading at negative interest rates. But will we see a rebound soon in those yields? With me to discuss this is Justin Knight, who's the bond strategist at UBS. Justin, welcome to the Financial Times. We've got a very nice chart to start off with, showing how Eurozone bonds have moved since the ECB started QE on March the 9th. What we see is quite a pronounced impact, particularly in German bonds. What's the cause of that?
Well, I think obviously what we've seen is a lot of central banks buying, but we've known that since January the 22nd. I think on top of that, there have been asset managers, some hedge funds, jumping on the bandwagon and trying to get long ahead of ECB buying. So
pushing the prices up.
Indeed.
But why Germany?
Well, Germany is the country which, of course, very famously has no net new issuance going forward, the black zero.
Rules. Yeah.
Absolutely. And so many investors look at it and they say, no net new issuance, therefore that market is going to be squeezed.
And that's why we're seeing the biggest impact at 10, 20 and 30 years on Germany. The other interesting thing, if we look at Spanish, Italian, where we have seen the biggest impact is not so much the shorter term bonds, but the 30-year debt. What's your explanation for that?
Well, I think it's the market was surprised that the ECB announced back in January again that they were going to buy bonds out to that maturity, but also there is less liquidity in that part of the curve.
Okay, so that's what's happened so far. Yields, as I say, going down to historic lows. But you think we might get a bounce back. What's the case for suggesting that yields might start rising again?
Well, we think many investors have anticipated the ECB buying, have gone long as a result, and those bonds will come out. On top of that, we think that expectations of growth and inflation have risen, and if we're all right about that, then of course the data should turn as well.
You think those factors are going to be sufficient to outweigh the supply constraints we just talked about?
Yes, because of course net supply only really counts if investors reinvest the maturing amounts. If instead they start switching into other markets, which we also expect, not just other bond markets but also equity markets, then of course there is more aggregate supply than the net issuance numbers might suggest.
Of course, a crucial thing in determining where bond yields are, of course, is what people expect with inflation. If we look at our second chart, what we've done is to show, we've just taken the French 10-year bond yield, showing, like the others, it's gone down to these sort of historic lows. But what we put against that is the five-year inflation expectations. This is what financial markets are pricing in for inflation in over 5 years, starting in 5 years' time. And the point is that we're seeing a bit of divergence.
Yes, we've seen a sort of general move up, certainly since the middle of February, in those inflation expectations. And this is a measure, of course, that the ECB watches as well. But it is a component of the nominal yield. So you should see nominal yields and inflation expectations move in the same direction.
Whereas what you've seen until, I mean, it's jumping around a bit, but a bit of divergence lately.
Yes, that's right. And so eventually something's got to give. Either nominal yields start turning up, which is what we think will happen, or inflation expectations will have to turn once more.
But what's going to happen to inflation expectations? That pickup, as we can see, is not very big, and inflation is still in negative territory on the official figures.
Yes, but you know, as I say, I do think that most people are expecting better growth, tighter labour markets, higher inflation, and for the first year in many years, we've actually got a net positive fiscal impulse on growth taking place.
Which should mean higher bond yields.
Exactly.
But if we do get a shift, if we do get a rebound, is it going to be smooth or is it going to be dangerous and disruptive?
I think a lot of that depends on exactly how long investors are and how much stretched this sort of elastic band of positioning has become.
Okay, and the final question, we haven't mentioned Greece. Is Greece going to send yields higher?
In the event of a Greece accident, i.e. Greece leaving the euro, which we don't expect, but we would think that core bond yields would fall and peripheral bond yields would rise. So what we're recommending is that investors go underweight of both of those.
Okay, Justin, we'll have to finish there. Thank you very much. So a suggestion there that bond yields might start to rise after all these falls we've seen as inflation expectations pick up.